Welcome to another great edition of Money Matters Boston TV. I'm Chuck Nilasek.
And I'm Dave McDonough.
Well, Dave, I know I say this every week, but we absolutely, positively have a great show. We have representatives from Pioneer Investments that are coming on, Loomis Sayles. Then you're talking to John Canally from LPL Financial.
Yeah, what we're looking for today is to give people some actionable ideas for the next 2 weeks. And again, we're almost at 2013 to let them know where they should have their funds invested.
Well, with so much to do, why don't we kick this show right off? Money Matters Boston begins
right now.
Welcome back. Well, this is the part of the program that we tackle some very important issues that are in the news. We like to call it trending topics. Are you ready?
I'm ready. Let's rip.
All right. Well, it seems a little disconcerting, but consumer spending is actually slowing down. Is that true?
It is true. And when you and I did this show a few weeks back, we talked about Black Friday and Small Business Saturday and what they call Cyber Monday and how those were great record-setting. What you're seeing is because of this dreaded fiscal cliff that we keep mentioning each and every week, especially on this show, people are starting to spend less. They realize that they're going to have less in January in their pockets due to the tax increases. So you are seeing that. People are reining in their spending. What
kind of things are they spending on? Is it luxury items like cars and computers and iPads, things like that, or is it just across the board everything?
No, and it's interesting that you bring that up. I mean, the new iPhones and iPads, they're actually seeing a slowdown. And what I think we should talk about as well is that the Apple stock is now in what's called bear market territory.
And we are seeing a big increase in, say, McDonald's. People are going out and buying Big Macs in droves. So is that maybe we're leaving the luxury restaurants and heading to more of the fast food joints?
Yeah, I mean, the consumers are mirroring what the businesses are doing, and that's pretty simple, right? They're hoarding their cash. They're afraid of what's next. And think about it. There's 2 weeks left. We still don't know what our tax rates are going to be.
It's scary. It's scary. Okay, next up, AAPL stock in bear market territory. I know we just talked about that.
Yeah.
Is Apple going out of business? What's the story here? I mean,
yeah, again, it's that law of unintended consequences where the stock, what that means, by the way, bear market territory, is that it's sold off over 25%. And we're talking over 2 months. Is it because Apple is slowing down or selling less product? The answer is no. What people are doing, or they're selling that stock to reap their gains this year versus January, because the capital gains rate is going to be higher next year. Yeah. So it makes sense to take the gain now versus waiting until January. That's exasperating the fall of that stock, Chuck.
And I see a lot, in reports and, how they're looking at the Apple stock. And a lot of people have those kind of stocks as just buying the stock, not as much in their 401k or their IRAs as much as just having it sort of in their portfolio sitting there on the side. Is that going to have any effect in this sell-off period?
You bet. I mean, most mutual funds, they were chasing returns going through September. They all had Apple in their top 10 positions. Now they're all running and chasing each other out the door, if you will, to sell the stock. So you'll start to see that those mutual fund managers will underperform the market. So again, fiscal cliff is causing people to sell Apple stock.
All right, now I'm going to make you make some predictions with 2 weeks left to go here, whether we go over the fiscal cliff or not. I'll give my prediction, but I'll wait to hear yours first.
So again, these are going to be trending next week. It'll be like the top of Google and everything else. What did Chuck and Dave say about the fiscal cliff?
Yep.
I think some tax rates will go up. Dividend tax rates will go up. I think that top 2% is going to go up. You'll start to see the blueprint for some spending cuts going in 2013. I think it's middle of the road. I think the market's going to throw their hands up and have a middle-of-the-road type year in 2013.
Well, I expect to have them go over, and mainly from a PR perspective, you can see both sides of the camps really preparing the public for this event to go over and say, look, that January 1st date isn't as dire of a date, drop-dead date, as maybe the media portrays it to be, which, again, I think the business community, the stock market, will react either way. They just want information more than anything. I think that's the big thing, is the uncertainty. Yeah, so I expect it to go over.
Yeah,
but
you nailed it, certainty. So you're certain that we're going over?
I'm certain that it'll go past the first without any real hard and conclusive resolution.
I can see why this is going to be a trending topic next week.
All right, well, why don't we take another break and be back with more Money Matters Boston in just a minute.
It starts with a goal. You know where you want to be in 20, 30 years. But how do you get there? Flagship Wealth Management can be your compass, guiding you through these challenging times, steering all your investments to the same destination. We are an independent advisory firm backed by the largest independent broker-dealer in the country. You can feel safe knowing our advisors have all the knowledge and tools to guide you to your goals. Flagship Wealth Management, helping you navigate your way to financial freedom.
This segment of Money Matters Boston is brought to you by SHP Financial.
Welcome back to Money Matters Boston. I'm pleased to introduce Richard Skaggs, Senior Equity Strategist at Loomis Sayles. Hey, Richard, welcome aboard.
Well, thanks for having me here, Dave.
Give me a little background on Loomis, if you will. I know the firm's been around since 1926, $181 billion under management. That's with a B. Give me some explanation. Is it a retail type shop, institutional? Give me some background.
Well, Loomis is primarily an institutional firm. We have business relationships all over the world. It is tilted toward fixed income in terms of asset size, but the equity business is an important part of the firm as well. 15 to 20 billion in assets of the total.
Okay.
And we manage money in a variety of equity styles.
I'm sure you're getting the same questions that we're getting over and over again. Fiscal cliff, 2 weeks left. What are you advising, retail advisors like me, what are you advising us to do for ourselves and for our clients?
Generally, I think it's important that people don't change their investment strategy based on these news events that are coming up. The outcome isn't knowable, but in my history as a stock analyst, I haven't seen many cases where there's been an event that's been so well publicized, so widely anticipated, that actually led to a major sell-off in stocks as it came to pass. People look back to July of 2011 and the budget debate there.
The
we
debt
did have a
ceiling
big
talk.
sell-off, the debt ceiling talks, right. And while stocks did sell off very sharply, the fact is that it presented an excellent buying opportunity for the long-term investor to get in July, August, and September of 2011. The S&P 500 rallied several hundred points from those levels. So if you want to keep some powder dry in the event that there is some volatility because things don't go as planned, maybe we don't get a deal, maybe we go off the cliff temporarily, that's understandable. But changing your investment strategy, we say no.
Well, I did a little preparation for our interview today, and I saw that one of your favorite books, actually your newest read, is The Great Crash of 1929. Is it because of this fiscal cliff?
I'm a student of the stock market and its ups and downs. And what we know in the very long run is that large cap stocks have returned about 9 to 9.5% a year since 1928, and that includes depressions, wars, recessions. It includes the financial crisis of 2008. And while it would be hard to have invested in 1928 and still be an active investor time-wise, the message from these books and from our work is that if you judiciously add to positions on weakness and you buy strong companies with good dividend prospects, the ability to grow dividends and grow earnings, household brands, companies you know, that you can do well over time. But it's not a game for 3-week or 6-week trades.
And lately that's been long-term investing, right? 3 or 4 months to some people is long-term.
Well, we should be reminded that to earn a long-term capital gains tax rate, you do have to hold an asset for a year. And many people don't think about holding stocks for that long of a period, but of course the real wealth, as Warren Buffett has shown, is generated by owning good businesses over very long periods of time.
It sounds like you like to educate. And again, you and I speaking before this interview talked about that you educate the Boy Scouts, Boy Scout Troop number 1, I believe, in Acton. And you actually teach, and if I'm reading this correctly, the Personal Financial Management Badge, where they actually need to get this badge in order to be an Eagle Scout.
Well, the Personal Financial Management Badge, it's interesting. It's one of the required Eagle badges. I'm not sure how many are required, but there's quite a few. It's a badge where we take a booklet prepared by the Boy Scouts of America, and it addresses how individuals, young people, can use debit cards, credit cards, savings. We talk about stocks, we talk about bonds, talk about time management.
I hope Congress is watching this show and applies to get that badge. Hey, Richard, thanks again for coming on board. Richard Skaggs, Senior Equity Strategist at Loomis Sayles. Hey, stay tuned. More Money Matters is coming your way in just a minute.
Are your investments in CDs and money markets returning less than you expected? There is a better way. Get a structured settlement transfer from SHP Financial and start earning better rates right away. Learn more by calling SHP Financial at 508-591-5070, and we will send you a free buyer's guide on this exclusive opportunity. Call now and you will be added to our email newsletter, where actual cases on the market currently are sent to you instantly. SHP Financial, 508-591-5070.
This segment of Money Matters Boston is brought to you by Flagship Wealth Management.
Welcome back to Money Matters Boston. I am pleased to introduce John Canally, Chief Economist at LPL Financial, the largest broker-dealer, independent broker-dealer in the country. There's 13,000 advisors that you and your team are responsible for. That's a big deal.
It is a big deal, and we try to do the best we can. So hopefully it'll continue in 2013.
Well, speaking of that, we were here, you and I had an interview just 6 months back, and we talked about where we thought the market would be in 6 months, and we talked a little bit about the fiscal cliff. This isn't a gotcha moment. I'm going to go to the tape, we'll watch it, and then maybe we'll comment on it. You ready for this?
Fair enough.
All right. You talk about the Senate race being almost as important as the presidential race.
Yes.
Can you address that a little bit?
Yeah, because in this case, gridlock is not good. So we've had gridlock here for the last couple of years. You've had a Democratic president, a House controlled by the GOP, and the Senate mostly controlled by the Democrats, but it's pretty close. I think the best outcome for markets would be to ungridlock things, to get one party in control of both the House and the Senate. It's not likely that the Democrats are going to take over the House because it's just too big of a climb. I think they would have to make up 25 seats. That's probably not going to happen.
Sure.
So the best outcome for the markets would be if they can pick up enough seats to win the Senate, which is likely. I think it's 4 or 5 or 6 seats, and that could happen.
Ungridlock things, good for the market. Gridlock, bad. What are your thoughts on that clip?
We didn't quite get there. Democrats actually picked up a couple seats in the Senate. So basically the same actors we have this year are going to go right into next year. Not much has changed. We went through a whole campaign season, spent billions and billions of dollars, and ended up right where we started.
So probably better off spent elsewhere?
Probably so. So what we're faced with now is getting the fiscal cliff resolved, and it's basically the same folks in power. Let's hope they can make some better decisions.
All right, let's go beyond hope. Our viewers are actually hoping we can give them more than hope during this holiday season. There's 2 weeks left. Now, I know you've got some probabilities on what could happen. Give us the probability you think is most likely to happen where it comes to the fiscal cliff.
I think the probability is that you somewhat go over the fiscal cliff. You get a couple of things resolved. You get a partial hit from the fiscal cliff. That might shave 1% off of GDP. So if you do nothing, that's a 3.5% hit to GDP.
Which is running at, what, 1.5%, 2% now?
So that's a recession, basically. So if they can come to some agreement that it removes some of the uncertainties, but we still get some of the hits, some of the taxes go up, some of the spending cuts go in, but it still gets us about a 1% hit to GDP. That probably slows economic growth down to near zero in the first quarter. The offset to that is we're going to get some rebuild from Hurricane Sandy. That's going to lift it. So first quarter GDP looks weak either way, probably somewhere around 1%. But what it sets you up for is getting the longer term deal in place.
All right, so your team, both you and your team, what is that probability in percentage terms? If we go down the middle, we do have some cuts, but we do have some tax increases, that in the middle phase?
That's about a 55 to 65% chance of happening. So, you know, and I think right now we're 2 weeks away. That looks like that's probably in the works. You're not going to get any kind of grand bargain in the next 2 weeks. There's just too much to do. In other words, you're not going to get tax reform. You're not going to get loopholes closed. You're not going to get some big deal that's going to cut the budget by $4 trillion in the next 10 years. That's just not going to happen. We don't have enough time. What's likely to get done is something just to get us to early next year where they can sit down and have a little more time to try to help get the longer term deal in place.
Now, what do we do in 2013? You talked about the GDP slowing by 1%. Are there certain sectors of the market that benefit from that, or won't benefit to a less detriment, if you will?
Yeah, I think right now every sector is hurting from the uncertainty being created by this fiscal cliff, whether it's consumer discretionary or technology or materials, they're all being hurt. One is being helped is sort of volatility. If you're invested in volatility, you're probably doing okay. But removing that uncertainty just by itself might help to lift all boats early next year.
I was going to ask you that. I mean, businesses are going into year end, having to cut people, having to lay people off because they don't know where their tax rates are going to be. So isn't that in and of itself a stimulus? If we can avoid this fiscal cliff in one way or another, do you think they'll put the money back into the market?
Yeah, you know, I think it's a two-step process. One is just to get us beyond the fiscal cliff, so get us beyond December 31st, January 1st, get some fix there. But then the longer-term issue becomes, can we put a tax code in place that's going to last for more than 6 months? So we've been living kind of paycheck to paycheck with the tax code for the last couple of years. There's all these artificial cliffs and artificial barriers. What businesses and what consumers want is certainty for a long period of time, 5 years, 10 years. Here's what my tax rates are. Here's what the loopholes are. That's what they want. They want certainty. I think once that certainty gets put into place, I think there is a pretty good possibility that we can ramp up the economy from, let's say, 2%, which is probably where we've been at in 2012, to up to 3%, maybe even 3.5% if we can unleash some of that uncertainty and put it to work.
Does that unleashing, if you will, what does that do for the, the total market growth for next year? What is your prediction? Last year it was mid to high single digits, which I think you're pretty much dead on. What do you think for 2013?
Well, I think in our base path, you get a 5% gain in stocks, 5 to 10% gain in stocks. But if you get that unleashing, if you get our bull path, and we can put a long-term deal in place to reduce the budget deficit, cut some spending, raise some revenues, that might get you to a 20% gain. And I think people are not really thinking about that. Now the other side of that is if we let this linger on till we hit the debt ceiling again. That's the real issue. So debt ceiling is coming up again.
Now that's in March, if I'm correct?
February, March, we might hit the debt ceiling. At that same time, the government runs out of funding. If we are still in February, March talking about that, that might be the bear case. That might be that we're down 20% on stocks. I think ultimately it all does get resolved, but between now and then, there's just going to be a whole lot of uncertainty. So I think the first step is getting over the fiscal cliff, and then setting the stage for that longer-term deal that could indeed lift us to a path where we're up 20% in stocks.
Well, I have it hot off the press is the path of least resistance put out by your research team. I have to tell you that I'm proud to be a part of LPL. I use that in my practice. I know my clients have certainly participated and have really valued you and your team's research. So again, thank you for that. John Canally, Chief Strategist and Economist at LPL Financial. Hey, stay tuned. More Money Matters coming your way in just a minute.
It starts with a goal. You know where you want to be in 20, 30 years. But how do you get there? Flagship Wealth Management can be your compass, guiding you through these challenging times, steering all your investments to the same destination. We are an independent advisory firm backed by the largest independent broker-dealer in the country. You can feel safe knowing our advisors have all the knowledge and tools to guide you to your goals. Flagship Wealth Management, helping you navigate your way to financial freedom.
This segment of Money Matters Boston is brought to you by Ross Mortgage Company.
Welcome back to Money Matters Boston. I am pleased to introduce Sam Wardwell, investment strategist from Pioneer Investments. Thanks for joining us on Money Matters.
Thanks for the opportunity.
Hey Sam, give me a little bit of a background from Pioneer. I understand they have the third oldest mutual fund in America. Value shop, in my opinion, over 80 years in the business. Can you give us a certain, what do you think Pioneer is truly known for?
Well, I guess two things. Number one, 80 years old. We have been 84 years old. We've been around. We've seen a lot of things happen. But more, I'd say philosophically, we have been a value shop forever. We believe that you make money by understanding companies, by buying them for less than they're worth. You buy bonds when the company's going to repay you. And so we are conservative, sometimes sort of boring. We like getting our money back. We like making money on our money.
Well, that's a simple premise, right? Making money when you should and not losing money when you should.
It's pretty simple.
Let's go over the not-so-simple fiscal cliff and what's going on over the next 2 weeks. You and I talked pre-production about what your thoughts are, and I ask you this, where does the market go after it?
I think the market does not know what's going to happen. If you look at how the negotiations are going, frankly, it feels to me a little bit like there's not going to be a decision before year end. That everybody in Congress and the President knows the year end is not really a deadline. They can change the tax law in January or February or March. They can wait till after the inauguration. December 31st is a media deadline, not a real deadline.
Well, that's interesting. I hadn't heard that, Sam. My question to you, if I'm a business person, I've got to plan what to withhold for payroll taxes and what I need to withhold and what I need for benefits. Isn't that kind of screwing up what I'm going to plan to do for business? Doesn't it screw up a business confidence?
Oh, it absolutely does. Businesses are scared to death.
Yeah.
And actually, who knows what the AMT is going to be, because that applies to 2012 taxes. And so when does the IRS start printing its forms? So there are some, shall we say, deadlines, but Congress isn't, I don't think, serious about, and the president's not serious about cutting a deal in the next week. So I think what's going to happen is people are going to watch it, they're going to be nervous, but we won't really get an answer. So we're going to go over the so-called cliff, and then in midair, we're going to figure it out.
You're saying this with a smile. I love it. So maybe optimistic. Because I saw a seminar that you put on called "Climbing the Wall of Worry."
Yeah.
Now I use it all the time in my practice, and I have people looking like straight. What is the wall of worry? Can you explain to our viewers out there, when you mention climbing the wall of worry, what that means to them as an investor?
Sure. I'll start off with a Warren Buffett quote. The key to making money, paraphrase, is to be greedy when everybody else is fearful, and fearful when everybody else is greedy. And I like the wall of worry because when a market is in a bear market, it goes down until everybody's finished selling, and everybody's pessimistic, and everybody's worried. And then as people gradually become less worried, as they gradually buy, the market climbs that wall of worry. And when there's no worry left, everybody's bought, and the market can't go up anymore.
Yeah, it's that Main Street theory, right? But by the time that Main Street jumps in and feels comfortable, is it too late?
The easy money's been made for sure.
Yeah, and you're saying that's the case right now?
I think that if we look at it now, I don't know what's going to happen next week. But if we take a 5 or a 10-year time horizon, stocks look really cheap, and government bonds look really expensive.
I mean, can you imagine lending your government money for 10 years and being paid 1.5%? I can't. But that's a sector of the market that is simply outperforming. I don't get it.
Well, I think it's all fear. I mean, if you look at 20-year Treasury inflation-protected securities, TIPS, they're yielding less than 0. People are locking in losses.
You're paying the government to borrow your money.
Exactly. And essentially, I think the only reason people lock in losses is because they're trying to hedge against the risk of a bigger loss. Safety is incredibly expensive. Fear is the dominant emotion in the market. And that leads us to think, well, there's got to be long-term investment opportunities if you're willing to accept some volatility. Nobody wants to lose 5% in the next 3 months. I understand nobody wants to lose money, but that means that things that might go down are really cheap.
Well, let's look long-term, and I'm putting this in quotes. 3 weeks from now, 2013, what is your feeling? What are the strategists feeling over at Pioneer? Where's a good place to have their money, and where isn't?
I think that the market's going to stay volatile, and it's going to jump around, but if the market goes up through the roof because they eliminate the fiscal cliff, we'd be tempted to take profits. Conversely, if we hit the fiscal cliff, let's assume that we hit the fiscal cliff, relatively speaking, full speed, probably causes a recession, but it cuts the budget deficit in half. And that's very good for the bond market.
Life gives you lemons.
Right. And you sort of go, I'd rather have a short, I think relatively quick recession, because the private sector is not leveraged up. The private sector is not overextended. There's not too much inventory. There's not too many new cars. There's not too many new buildings. If we have a recession, it's a brief, short recession, and the economy is growing again by the end of next year with a small budget deficit.
What I'm hearing right now is you're seeing good signs to be optimistic going into 2013, and I think that's important. Thanks for joining us today on the show.
Thanks for the opportunity.
My pleasure.
Thank you.
Sam Wardwell, Pioneer Investments. Stay tuned, there's more Money Matters coming your way in just a minute.
Peace of mind. Everyone wants it. Few people find it in today's uncertain economic times. Ross Mortgage understands that finding the right mortgage can be stressful. That's why we created programs like Custom Closing to save you time and give you the peace of mind so you can concentrate on the things that matter the most to you and your family. We'll walk you through every step to assure satisfaction. You can be confident that we'll close your loan on time, every time, guaranteed.
Ross Mortgage. Allow us to show you the way home.
Welcome back, everybody. This is the part of the show called The Hot Seat. I put my co-host Dave McDonough in the hot seat, see if he can answer the questions provided by you, the viewer. So are you ready?
Yeah, I'm in a comfortable seat today, actually, Chuck.
Well, we'll
It's
heat
very
it up.
nice.
Here we go. Let's heat this show up. The politicians in Washington can't seem to agree on anything, and I'm concerned we are about to go over the fiscal cliff. Should I sell all my stock in mutual funds? That comes from Roger in Manomet.
Roger, I'm in agreement with Richard Skaggs. He was actually a portfolio manager we interviewed at the beginning of this show. We don't advise people to let the, I can't believe I'm using this, but let the tax tail wag the dog. It's more important that you stick with fundamentals. And fundamentally, our economy is on, we'll call it solid footing. Businesses are sitting on record levels of cash, so that's not going to change. Will there be a drop in the market if we go over the cliff? Absolutely. But as Mr. Skaggs had mentioned, I think it's a buying opportunity.
Next one comes from Stan in Hopedale. I am 62. I would love some extra income, but I don't really need it. Should I apply for Social Security now or wait until I'm a little bit older?
Well, Chuck, you and I talk about it almost every week on this show. If you can avoid it, it's better to take it at 66 or 67, a full retirement age. So that's what we suggest for people. If you can afford it, you should wait.
Yeah, and there's some calculations you can actually do to say, what if I waited till 67 and maybe took some accelerated amounts out of my, 401k, my IRA. Look, I mean, there's an argument to be made that we're in a lower tax range now than we're going to be a few years down the road when he's 67. It might save him some money, but sit down with a professional who specializes in Social Security, and I'm sure you'll get the answer that makes the most sense. Moving along here, I purchased a mutual fund in September and just paid a capital gain on that. I haven't heard anything on my new purchase since I've received the gain. Can I do anything to avoid paying taxes on it? That comes from Karen in Weymouth.
Yeah, Karen, it's an interesting question, quite timely. What will happen is mutual funds are required to kick out capital gains distributions end of November, beginning of December. So if you purchased the fund in November and you're flat, you haven't made any money, you still have to pay taxes on that gain. Make sure you pay attention to it, act on it before December, and if you have any losses in the account, take them now. Offset that loss versus a gain. There's no need to pay the IRS any more than you have to.
There you have it. You did a good job. Next week, though, is our big holiday Christmas extravaganza. You ready for it?
I may even let our viewers know what my favorite Christmas song is. You?
Ooh, I'm excited for it. Steve Sweeney, comedian, Joe Malone, regular contributors to the show. We have attorney Denise Willette. She'll be on. It's going to be a lot of fun, so get ready to hang with us for our big Christmas extravaganza. Maybe Dave will do his impression of the Rockettes. I don't know. You check it out next week to find out for yourself. Thanks so much. And if you're in need of seeing a little bit more of us or hearing more of us, every Sunday at noon on 96.9 Boston Talks WTKK, you can hear Chuck and Dave on Money Matters Boston Radio. So thanks. Have a great week, everybody.